So what I want to do today is I want to take these formulas and we're going to do a few practice problems. So after we get through the exam, you're going to start doing these Excel applications pretty quickly. So you're going to learn some Excel in this class. Most of them, or all of them, except for the very first one, all of them have a YouTube video that walks you through it. So I'm going to be doing some things in class. So I prefer in class, don't try to necessarily get every single thing down because you're going to have YouTube videos that are going to do this plus the class feel on YouTube. Try to step back and think about what we're doing. So I wanted you to see taking these formulas and actually making business decisions with them. So we're going to take these two formulas, the PBIFA. I'm going to copy it into Excel just so we can see the formula as we build it. So I'm going to go into Excel, a whole new spreadsheet. There's the present value function. And then the future value function. I want the actual formula. I don't know where the formula is, but all right, so somehow I lost the formula, but I'll bring in. So the future value formula is 1 plus the rate raised to the n minus 1 divided by the rate. If you have Excel on your laptop, you might try to keep up with me. So what you're going to do in your homework is you have 5 homework problems. The YouTube works the first 2, and then you got to work the other 3. So what we want to do is, you might, if you can build it here, it saves you time when you build a homework. I'm not going to do anything that's in the applications. I'm going to do a completely separate problem. But we want to build these. So you want to have the rate. You want to have time. So let me start with this first example. So I've got my mom's house. So I'm thinking about that. Let's just as an experiment. So I'm going to sell her house for $540,000 bucks. All right, I've already bought it from her, but I'm going to sell it. So she has no risk. If I get more than what I bought it from her for, she gets all that money. I'll gift it to her. So she's kind of interested in this, even though she's already got her money on the house. We got a contract. We're getting really close. The buyers are, you know, they're already hiring interior direct decorators. So I think they're pretty serious. They've already got approval on the loan. So it looks like we got a pretty good deal going there. And right now, interest rates, I think they got a loan rate at 3.45, but that's what I want to experiment with. How material are mortgage rates to the mortgage on a house? What do you think is a typical mortgage? How many years? 30 years. Yeah, you could do 15 or 20. We could experiment with that as well, right? How much does your mortgage rate go up if you go from a 30-year mortgage to 15? It doesn't double, but it does go up. So let's say 30 years. But those aren't correct because that assumes we pay the mortgage annually. What do you think we're going to do? Monthly. So why do we need to do this 345 to make it monthly? Divide by 12. All right. So we'll do that. Divide by 12. Now, people always ask me, why do you use the plus sign? Why don't you use the equal sign? I use the plus sign because the plus sign is right next to the 10 key. The equal sign's way over here. You must say, big deal, it saves you 1 second. When you're on Excel 10 hours a day, 1 second every 3 seconds, every 10 seconds saves you a lot of time. You get really fast. The other thing you want to do is use Excel without the mouse. If you're using the mouse too much, you're not using Excel well. So you got to get fast. It makes a huge difference. I watch students on Excel and it almost gives me a heart attack because it's like, why? It's just so slow. Why are you doing that? And it makes a huge, when you interview with firms, you've got to be fast in Excel because that's, you know, especially accounting and finance, that's what you're doing all day. So you got to get fast. All right. So our monthly rate is going to be 29.29%. And then how do we convert the time into months? Here you multiply by 12. So 360 months, all right? So if the rate's monthly, the time has to be months. If the rate's weekly, the time has to be how many weeks? As long as you do that, you're good. And we're gonna put both factors in. We don't, well, anybody, this is a tough one. Is this a present value interest factor problem or a future value interest factor problem? Anybody remember? All right, so how do you tell? So the question is, do we have the price of something today and we're going to borrow money for it? Or are we saving for something in the future and we want to? So what are we doing today? Do we know the price today? Are we saving for this house for the future? Or are we buying it today and borrowing money? Buying it today. It's a present value function. All right. When you're looking at debt, that's a present value because you know how much the house is worth today. That's the present value. You want to know what those monthly payments are. If you're going to save for a house, so we could buy a $540,000 house in 30 years, then it would be a future value problem. So we're gonna put them both in there though. Present value interest factor annuity and a future value interest factor annuity. We'll do them both. And then you just have to build it. You can't use the little squiggly lines. You have to use all parentheses, but you just do it exactly like it's written there. 1 minus 1 divided by 2 parentheses, 1 plus the rate, close 1 parentheses, raised to the time, close parentheses twice, divided by the rate. See how I did it exactly like it's in the formula? Can y'all see that? Is that large enough? So if you type it exactly like it's in the formula, you're going to get it. Now in a present value function, you'll know you did it right or have an idea if the factor is less than the time. So we should get something less than 360. On the future value, it should be more than the time. All right, so if I hit enter, does that look like that could be right? Looks good, right? I'm not going to round, but if you remember from your accounting books, the present value interest factor factors, when they had the table, I don't know if they use the table anymore, but if they had the table, usually goes out 4 decimal places. Why 4? Well, because we're usually dealing with dollars and cents, so we're only going out 2 decimal places. So if you go out 4 decimal places, it avoids serious rounding problems. We're not going to round, and you're going to see why on the exercises you don't want to round, because then you know you got the answer exactly right at the end. All right, how many people are able to get that are trying to keep up with me? Anybody? All right, good. All right, so a few of y'all are good. All right, the future value is a little easier formula. Here you do open parentheses twice, 1 plus the rate, close parentheses, raise the time, minus 1, close parentheses, divided by the rate. And here we should get something greater than 360. That looks like it's about right. We don't need that one in this problem, but that looks about right. The other formulas we need are the present value equals the payment times the present value interest factor annuity, or the future value equals the investment times the future value interest factor annuity. Here, we know the present value is what? What's our present value? 540,000. That's going to equal our loan payment times 224.0855. So that means our payment is going to equal 540,000 divided by 224.0855. So we're trying to figure out that payment. So you take how much the house costs, divide by that factor, and that tells you what your monthly payment is going to be. If we did a future value, it would be, yeah, we'd have to, that's how much we have to save every month. So we would have 540,000 in 30 years from now. Well, we need 540 today. We're going to borrow from the bank. That's the present value function. You'll get some practice on this, especially you get 5 problems, and you'll have more problems as well. Well, let's try it. All right. So the columns are always the same. You're going to see this in all of our examples. You start off with time. Then we have a beginning balance. And then we have interest. In this case, in a present value problem, it's an interest expense because we're paying off the loan. We owe the bank interest. On a future value problem, it's our interest earnings. It's our money that we earn. But here it's interest expense. Then we make our payment on the future value. It's not a payment, it's an investment. So here we're making a payment to the bank on the investments. It's our own money. And then what do you think the last column is? Any guesses on that? Ending balance. And what do we want? What do you think we want the ending balance to be on month 360? 0. If we did it right, it should be 0. If you don't round, if you keep everything unrounded, then you will get exactly that. Like if I do this formula over here, 540 divided by that, it won't work because it goes out more decimal places than that. So I'm actually, even though it looks like I'm dividing by 224.085, I'm actually dividing by 224.08547052882. Goes out all those decimal places. You're better off in Excel not rounding. Then at the very, very end, you should get right at 0. You know you did it right. If you round it, like the dollars and cents, only go out 2 decimal places, you can be off $3 or $4 at the end because rounding can be a problem. All right. So we're in months here. How many months do we need to go down? We start with from month 1. What should be our last month? 360, right? So here I do plus that month plus 1. And I need to copy that down about 360 rows. We're going to go way down here. Right. So how do I get the bottom of that series of numbers? Here's what bugs me. Students do this. And 6 months later, they're done. You may know a faster way to do that. I'm sorry? Control shift will highlight it all. That's right. How do I get down if I don't want to highlight it? Just control down. But yeah, very good. Control down, and I want 360, so I go find the 360. So here, you're Daisy, right? Okay, so here Daisy, yeah, exactly. Control shift down, it highlights it. I can hit delete, and I got, yeah. So get used to the control up, control down. You know, it's so much faster than scrolling. You really should on Excel. If you're touching the mouse too much, you're wasting time. All right, so we got our 360. What's our beginning balance? We're borrowing money. How much did we borrow? 540. If this were a future value problem, what would be our beginning balance? Be 0, right? Because we're saving the money, but here we're not saving. Our interest expense is always going to be the beginning balance times our rate. So our beginning balance is 540. Our rate is 0.29. We always want to reference B1. How do we make it always reference B1? You may know that one. Dollar signs. Yeah, your function 4 key. If you're on a PC, if you're on a Mac, I think it's Control F4 or something. I can't remember. Like Command. Is that right? Command F4 or something. But you want those dollar signs around the B1 because we always want it to be B1 as we copy it down. So there's our interest expense. I'm going to change it to commas. There's the comma right up there. And what is our payment? We said our payment is the 540 divided by the present value, interest factor value. So our payment's going to be $2,409.79. So which one? This is the reason I'll do the YouTubes. We won't do many of these in class because most students prefer the YouTubes. That way they can, did y'all know you can speed up and slow down YouTubes? As fast as I talk, that might not be a bad thing to do. All right. So a big chunk of your payment, $1,500 or $2,400 is just pure interest. You're hardly taking anything off of the principal. Is the payment going to be the same every time? Yeah, it's going to be the same every time. You can, I'm going to show you, I'm going to actually just reference it, but you can do it either way. Either way works. Yeah. So if you want to dollar sign that, you have to dollar sign both of them. I just prefer to get the first one in there, and then after that, I just go up to it. But either way, it works. Now, any balance on a present value function is you owe the bank $540,000. You pay $2,400, So you subtract that, but the bank's charging you 1,500, so you have to add that back. So you actually take the beginning balance, add the interest, subtract your payment. So your balance is only going to come down about $900 because you're adding so much interest to it. So let's see how many of y'all can get that ending balance of 539,140. Anybody got that? Who's got 539,142.71 here? Matthew, Susie, Daisy, probably. Yeah. Ashley, yeah. All right. Our beginning balance the next month. It's just your ending balance from the previous month. So you just reference that, bring it right on over. Our interest expense, we can just copy that down, right? So our interest expense went down $2 because we paid off $900 of the loan. So that's kind of nice. Our interest is coming down. And so the Jesus's point, I'm going to reference the payment here and just reference up to it because we know it's the same. But if you wanted to, you could have locked in the two and copy it down. And our ending balance, we can just copy that down. Once you get your second line set up, it all copies down perfectly at that point. All right, you got to get the first line set up, get the second line set up, and then the second line just copies. All right, anybody have an idea how I can copy this down to the bottom? Yeah, I did just equal that previous one. I do the plus sign, you don't have to do the plus sign, you can just equal. Bill Gates added the equal sign. I didn't actually use it. All right, so here's what I see students do that I'm going to sue someone for giving me a heart attack but I see this. Oh my word, that is just so slow. I see so many students do that. So what's an easier way of doing it? Any guesses here, Daisy? The green thing right here, right? Just double click on that. And what is Bill Gates doing? He's saying, hey, you know what? There's stuff in here that goes down 360 rows. They probably want that copied all the way down until you run out there. So how far down did he go? He said, you know what? You got something here. I assume he just wants to copy that down until the very last line. So yeah, as long as you have it set up, you got, and does it look like we did it right? The last balance is 0. Now, it may not be exactly 0 because there's a flaw in Excel that doesn't quite do rounding correctly, but it's close enough. It's close enough for our purposes. So we have a mortgage here. So how material, the rate could change and the time could change. So when I graduated from college, before your parents were probably married or even born, maybe, mortgage rates were like 19%. How material do you think that is? Let's take some guesses. So at 3.45%, our mortgage was 2409.79. Anybody want to guess if our mortgage is 18%, what our monthly mortgage payment would be? Take a stab at it. 3,000, 3,500, 4,000. Any guesses? It's going to be more, right? If you're paying more in interest, it's going to take you a lot more money. No guesses? Or some of y'all may have already done it. 9,000 could be that high. We'll see. Let's try it. Our mortgage rate is 18%. Yeah, good guess, Santi. $8,000. Mortgage rates go up. What is housing affordability going to do? It's going to drop dramatically. So, how many of y'all can afford how many of your parents can afford an $8,000 a month mortgage? That's a huge, but when I graduated from college, that's what mortgage rates were. People could not buy houses back then. It is true housing prices are up a bunch, but with mortgage rates so low, they're still pretty affordable. So yeah, that makes a big difference. So 8138. The other thing we can do, actually the monthly rate here is mortgage rates our annual rates almost got down to the monthly rate, just amazingly. So let me put the 345 back in there. What about time? How much do you think your mortgage would come down if you went to, I mean, how much would it go up? How much would your mortgage rate go up if you went to 30 years? Any guesses on that? Now, it's probably not going to double, right? But how much would it go up to? 3,500, 4,000? Any guesses on that? How much? Up 1,500? So 2/4.
Like 400.
Go up 400? So 2,800? All right, let's see. I think it's going to be more than that, but we'll see. So it goes up to 3,800. So it is significantly higher, but it's not twice. And you're getting it paid off in 15 years instead of 30 years. So, you know, if you think about it from this standpoint, this times 360 versus this times 360. Oops. If you think about it from that standpoint, not 360, 180, right? Excuse me, 180. Think of that standpoint, you're saving what, about $180,000 in interest by paying off in 15 months instead of 30 months. What should you do? Well, I would look at the mortgage rate. If the 30-year mortgage is 3.45% and the 15 is 3.4%, I would get the 30-year mortgage, but then pay it off as if it were 15. Right, because there's not much penalty. If the 30-year is 3.45 and the 10-year is 2.5, 15 is 2.5, then yeah, get the 15 because your interest rate's much lower. But if they're about the same, get the 30-year because the bank doesn't penalize you for paying off early. You can pay extra money. So yeah, if the interest rates are the same, then just get the 30-year, but then pay it the higher interest, the higher payments. If the rates are very different, then you have to kind of decide what's the better decision. So it gets a little tricky. But it's fairly sensitive to these numbers. I think the rate's the most sensitive one. If interest rates, you know, even just 5%, you know, if rates get back up to 5%, you know, you're seeing a good $400 a month jump, and they could, you know, mortgage rates have gotten up a lot higher just in the last few weeks. So, you know, you're talking, you know, people, I don't mean a few $100s a year. This is a few $100s a month. So you're talking thousands of dollars a year just because you waited 2 months to get your mortgage done. Fortunately, the guy buying the house from me, he's already got his rate set with his mortgage company, and he's got 345. So that's probably a pretty good rate for him. He's probably pretty happy about that. The bank might be thinking, you know what, well, we might want to cancel his contract and have him come back because they could probably get, you know, 4.25 or something. I don't know what mortgage rates are today. I've never borrowed money in my life, so I don't know. All right, so there's a present value problem. So how do you do the next problem? Well, what I recommend you do is just take all of this and copy it and take it to the next sheet. And then you got it all set up for the next problem. Because you don't know if you have a present value problem or a future value problem, but you got them both there. All right, so let me give you a problem. You tell me what it is. Mary needs 2.5 million, 20 years saved to retire. Currently has 250,000 saved. She believes she can earn 6% on investments. Is that a present value problem or a future value problem? Future value. Whenever you're talking about saving for the future, that's a future value problem. When you're talking about loans and borrowing money, those are present value because you're borrowing money for something you know the price today. So it's a present value. How often will she invest? Well, let's say she invests bi-weekly. Why might she do that? When I worked at USA, they paid us every 2 weeks. That's a good time to stick money into your 401k plan, right? Bi-weekly. All right, so someone give me the numbers. What's the rate going to be here? Not 12, it's not monthly, so we're doing bi-weekly. How many weeks are in a year? So bi-weekly means every 2 weeks. So how many weeks are in a year, first of all? About 52. So if you do every 2 weeks, how many 2 weeks are there in a year? 26. 26. It may not be exactly that, but that's close enough. All right, so for how many bi-weeks is she going to invest? $20 years. Yeah, times. So that's always going to be a case. Your rate, if you divide by 26, your time you're going to multiply by 26. That's always going to be the case, right? If you divide by 52, you're going to multiply by 52. Divide by 12, you're going to multiply by 12. So those two will always be the same. So she's going to make 520 investments, and she'll make about 0.23% each of those bi-weeks. Now here she doesn't have a price, she has a target. What is her target here? 2.5 million. Well, she already has that. We'll get that in the beginning balance, right? So we'll have to figure that out, but it's going to be, I'm making it a little bit tricky here. All right, so our present value factor is all set up, right? We don't have to do anything there. Future value is set up. All right, so let's start off assuming she doesn't have the 250, and we're going to come back and adjust for that next. We'll leave that out for now. It gets a little tricky. All right, so y'all give me what are the columns? Time, balance. Here's interest earned. May not be interest, right? Because you may be buying stocks, but we'll say interest earned. That's fine. You can just say gains. The next one, it's not a payment, right? What do you say this is? An investment. And then the last one, balance. All right, starts at time 1. We need to go up 520. All right, so we're going to assume that the beginning balance is 0. We're going to come back and try the 250 later. All right, how much interest do you make if you have 0 invested? So you start with 0 and you increase that by 23.23%. So you make 0. Right here, the future value equals the investment times the future value interest factor annuity. So here, 2,500,000 equals the investment times 1003.3964. So we need to invest 2.5 million divided by 1003.3964. So here we take the target divided by a factor. So she needs to invest $2,400 a month. That sounds like a lot of money. I mean, every 2 weeks, my word, every 2 weeks, that's a lot of money she's got to invest. Here on the ending balance, remember on the loan, we added 2 of them, subtracted 1. But when you're doing investing, wonderful thing about investing is all your money. So you just add all 3 of them. It's just all your money, everything goes across as your money. The beginning balance the next time is the same as the previous ending balance. Our interest, we can copy down. We're going to invest the same amount every month. And the ending balance we can copy down. And then we can copy all of that down. And if we did it correctly, what should be at the very, very end? 2.5 million, does that look right? It's like it worked. Now, what does Mary say when you tell her, oh, you just need to invest $2,500 every 2 weeks? She might pass out, right? What's she more likely to do? She's more likely to start with maybe $1,000, and as she gets raises, she'll have to do more. But the more she can invest today, the much better off she's going to be. But I don't know many people that have 20 years of retirement that can invest essentially what, $5,000 a month. That's a pretty hefty amount for most people, right? Not many Americans can do that. All right, so what do we do with that 250,000? That's going to be pretty tough. This is the way, there's several ways to do it. But one thing we know, she's got 250 today. So one thing we can do is figure out just that 250, what would it be worth in 20 years? We could do that, right? The future value of the 250 is going to be worth that. Anybody agree with that? The 250 is going to be worth 1 plus 0.23% raised to the 520th. Anybody see what I'm doing there? So 250,000 times 1 plus 0.23 raised to the 520. That $250,000 should be worth $828,000 in 20 years. Anybody disagree with that? So the future value equals the present value times 1 plus the rate raised to the end. Anybody want to disagree with that? Anybody confused about that? So she doesn't need $2.5 million. How much does she need to save for it? Her 250 is going to get her 882 of that. So how much does she need? She just needs 2.5 million minus that. That should do it. Is it going to work? I don't know. We'll see. Did it work? It worked. All right, I'll do that all again because some of y'all got like really furrowed brows. How much did that help her? Saved her about $900, right? $900 every 2 weeks. That's, you know, that's probably still pretty rough, but at least a little better. So let's do that again. I don't know if anybody want to explain it all versus me doing it. So she's got 250 today. She needs 2.5 million. We know the 250 is going to offset of that. How much is the 250 going to be worth in 20 years? So we want to know how much is that 250 today, that's the present value, going to be worth in 20 years. So we take the 250 times 1 plus our rate. I kept it with the biweekly and the 520. Why? Because I wanted the same compounding that I'm assuming in my schedule. So she has 250 today, 250,000 a day. She's going to invest it and make 0.23% every 2 weeks for the next 522 weeks. So she should have 828,882. So if she did nothing, she just kept that 250, did nothing, she should have $828,882.52. She needs 2.5 million. So we take that 2,500,000, subtract the 828. So what's my beginning balance now? 250. If we did it right, she'll have her 250. What's the chances she'll have exactly $2.5 million? Very unlikely, right? What's the chance she's going to make exactly 6%? Very unlikely. So it's an estimate, plus or minus. What does she need to invest in to make 6%? She's not going to get that with bonds, is she? Bonds are going to make her 2.5%, 3%. So she's going to have to get in the stock market. She probably doesn't have 250 now because the stock market is sold off so much. So maybe she has 248. You know, it's a moving target. It's a really tough target. But you have to make assumptions. All right. There may be other ways to do this, to figure out this 250, but that's just the way my mind thinks about it. I say, okay, what's that 250 going to give her? Let's subtract it out, and we can go from there. All right. I don't give you this type of problem in the Excel applications. The one problem you have in the Excel application that you have to think through is, I'm curious how many of y'all can figure this out because it's a good problem, pretty realistic. Is you go to the dealership and they'll sell you a car at a 6% rate, but they'll give you a cash back bonus. Or you go to the credit union, they have a lower interest rate, but you don't get the cash back bonus. So you got to figure out which of those is the better deal. You can do that here. All you got to do is say, hey, the beginning balance on the loan, if I do it through the auto dealer, it's cheaper than if I do it through the credit union, but my interest rate's higher, and you just do it as two separate problems, and then you figure out which one makes you have to pay more money at the end. So a lot of times it's just kind of logic through, how to set up the problem in a way that you're capturing exactly what's going on. All right, let me show you a spreadsheet I built. I'm not saying you should use this for your retirement planning, but it kind of basically does it. So it's called the Carroll file for some reason. I don't know why. Let's say you go talk to someone named Carol and she wants to do some retirement planning. She's 25 years old. And you sit down and say, you should be able to make 5% in your portfolio. That has to be after tax, right? But maybe she's got a Roth IRA, or maybe she's got a 401k Roth, whatever, 5%. What's a Roth IRA give you? So no tax deduction today, but supposedly you'll never pay tax. I don't actually believe that. I think the government's lying to you because my generation is so indebting your generation. I really think your Roth IRA will be taxable, but they're not telling you that now. But anyway, as far as you know, if you put money into the account today, it's tax-free. And then when you retire, it's tax-free when you take it out. It's a pretty good deal. If you do a traditional IRA, you get a tax deduction today. Don't pay any tax, but then you have to pay tax when you take it out. So most people say a Roth is better. A Roth is better as long as government keeps its word and doesn't tax you on the other side. But I don't think they're going to keep that word because they're going to be bankrupt if they do. So she's going to make 5%. She thinks inflation is going to be 2%. Well, that's pretty important because she's planning for retirement. If she's making $45,000 a day, that $45,000 is not going to buy her much when she turns 65 because of inflation. Now, inflation recently has been what, 5-6%? That would be pretty devastating for her, right? If she's going to make 5% on her portfolio and inflation 6%, she's never going to make. She'll never be able to make it. So we'll assume inflation is going to come back down. Jerome Powell is going to get the Fed to fix all of this. She's 25 today. She wants to retire at 62. Now we could change that figure, right? That's something she could certainly push that number back. And then we got to figure out how long is she going to live after she retires. That's a pretty tough number to do. Her life expectancy is 85 years. What's wrong with using 85 years? That's her life expectancy. What's the probability she lives longer than her life expectancy? Anybody know that number? What probability you have to live longer? If your life expectancy is 85, what's your probability of living longer than 85? And it's in the definition of life expectancy. What would be your best guess? Well, it's 50%. You have a 50% chance. That's your life expectancy. That's the age half the people die before the age, half the people. So why can't she use 85? Well, she has 50% chance of living longer than that. So she can't assume, I run out of money at 85 and, 50% of the time she won't. She'll keep living. I think, in the US, I think women is 85 and men is 81 or something. I can't remember. I jokingly tell people I'm going to move to the UK when I turn 70, because in the UK, it's even more diverse. There's like 7 women to every man over 70 in the UK. I mean, it's really skewed. US is not quite that skewed, but women definitely live longer. That's a negative, right? For women, is you have to save more for retirement because you live longer. So she said 95. I'm going to actually show you a solution to her living longer than 95. It's a product I tried to patent when I was at UTSA, and I couldn't convince the actuaries. I'll let you see if you think it's a good product. I think it's a wonderful product, but we'll see if you like it. And then the other thing, and this is the way I do financial planning, I say, okay, Carol, assume you retire today. In today's dollars, what could you live on comfortably? And she said, yeah, I can live comfortably in $40,000. Now, could she live comfortably in $40,000 when she turns 62? No way, because of inflation. But let's put it in today's dollars. All right. So she's giving me all this information, and I'm going to use something called concatenate or text. I love using text. You can embed that text with numbers. I don't know if y'all have ever done that before. But like this 40,000, watch the 40,000. If I change that to 60,000, automatically updates it. So it's kind of a nice kind of training tool where everything just kind of automatically changes. So it just walks you through. So what we got to figure out here is how much just got to save for retirement. If I had a good place I could show you, I would. I might be able to show y'all here. We'll see. I might have it graphed out. But what's she going to do for the next 37 years? She's going to save monthly. And when she turns 62, she needs to have a portfolio that she can start taking money out. It's going to pay her until she dies, but it's got to pay her something that increases with inflation. She can't have something that pays her $40,000 in 37 years and keeps paying her $40,000, because she's going to be really poor because of inflation. So we have to adjust for inflation. So she's going to accumulate for 37 years, and then she's going to accumulate for 33 years. Okay, that's the problem. She wants to know how much should she save on a monthly basis. So she monthly investment. So she's going to retire at 37. And so I'm doing all of this. All of this is calculations. So it's kind of cool. We got it every time you change a number. I don't know if I've got it both ways. I use text here and I use concatenate there. So you have to decide which you want. The biggest problem with these is knowing exactly how to format it in dollars or percents. You have to go find these words because it gets a little messy. But you use a little ampersand thing to tell it that this you want it in dollars and how many decimals you want. So we're going to ignore taxes, which makes life a lot easier. It's really hard financial planning. Most people assume the tax code is going to be exactly the same in the next 70 years. I think that's a pretty wild assumption to make. So, we'll see. She has no other savings, so she doesn't have that 250,000 that Mary had. So she's starting from ground zero, which is pretty bad at age 25, but a lot of people at age 25 do start with zero. So how much does she need to invest? Well, let's first figure out how large that portfolio needs to be when she turns 62 so that she can pay herself for the rest of her life. So let's figure out what that target is. So she needs $40,000 annual income, but that's in today's dollars. So what does she need in 37 years? Anybody recognize this formula? Can someone explain what I'm doing here? $40,000 times 1 plus 0.02 raised to the 37. What is that? The future, it's a future value. Future value of what? It's the income she needs every year in future values. So how much will that be? She needs $83,200. If she has $83,200 a year in annual income starting at age 62, it will buy just as much stuff as $40,000 will buy today. Now I use a rounding function. I round it to the nearest 100. You don't have to do that, but I do that here. And main reason I round with financial planning is we're really like this, right? She's going to make 5%. Well, maybe she'll make 5.2. Maybe she'll make 6. Maybe she'll make 4. There's so many estimates. I don't like going out decimal places like we're that precise. I used to kid the poor accountants at UTSA. I would always go out like 6 decimal places on a number that I knew there was no precision on. And I was like, obviously they know I'm joking. And they say, yeah, I know you're joking, but I couldn't hear the last digit. I was like, yeah, I was joking. You don't need those digits. So to me, I have this debate with accountants. Accountants, you know, they think there's this precision that's just not there. And it's like, you know, plus or minus 20%, my word. It's just, we're guessing on these numbers. So I like to say, let's use unrounded numbers so people know these are estimates. They're not precise. So she needs some portfolio large enough to pay her $83,000 a year at 62, and that needs to grow with inflation. All right. So let's figure out. So now we need $83,000 for 33 years between 62 and 95, growing with inflation. What's the present value of that at age 62? That's how large her portfolio needs to be. Okay, she needs a portfolio when she hits age 62 can give her those incomes. So she needs $83,200 for 33 years, but it has to grow with inflation. So what should she do? That's a present value function, present value interest factor function. The problem is we don't have a fixed amount. She's not getting 83,000 every year. She's getting 83,000 and then an extra 2%, an extra 2%. There's a trick you can do with that. Remember that PVIF function, we had a rate. We would think the rate would be 5% because that's what she's making on her portfolio. However, what we're discounting is growing at a constant rate of 2%. So this is a real good trick. We'll see this later when we value stocks. If we're trying to take a present value interest factor or something and our discount rate's 5%, but the thing we're discounting is growing at 2%, all we have to do is change our discount rate to 3%. We just take the 5% that we're going to make on portfolio minus the 2% growth rate. We use a 3% discount rate and it fixes for inflation. It's pretty cool, right? You automatically have inflation embedded if you just reduce your discount rate by the inflation rate. It's really, really cool. So instead of using a 5% discount rate, we use a 3% discount rate. And that gives us a present value interest factor, 1 minus 1 divided by 1, that 0.025. That's that 3% divided by the 12, raised to 396. That's 33 years times 12. There's our factor. So you take the 6933, which is the monthly amount she needs. So the $83,200, we divide that by 12. So she really needs $6,933 a month, growing with inflation. We take that times a factor. She needs $1.7 million, which she's earned 72. If she does that, she'll have a portfolio that will be able to give her $83,000 when she retires, and that will grow with inflation. She should be fine. What if inflation actually is 4.5% when she retires? She's in a lot of trouble, right? Throw this whole thing out. She comes back and sues me for not doing a good plan. And I say, how could I know that was going to happen? I'll be dead by then anyway. So that's kind of a nice thing about giving bad financial advice. All right. So the question is, how much do you need to save so you can get that $1.7 million? So here, the 1.7 is a future value, just like the problem we just did. She's going to make 5%. It's pretty straightforward. Her N is 444, right? Because she's going to invest monthly for 27 years. And so that factor is 1 to 1280. So we just say she needs to invest 1,360, which is that target portfolio divided by the factor. Now, that's pretty complex. However, I would tell you, there's nothing in the spreadsheet that that we haven't just done when we did the mortgage and we did the retirement plan. All the formulas are in there. Let's see though if it actually works. And then I'm going to show you a trick. I'm going to hide that. I don't want y'all to see my magic. I'll show you the magic later. So age 25, month 1, how much does she have invested? 0. All right. So she right out of college, doesn't have any money. When I left college, I think I had $3,000 saved up. So we don't have a lot of money, right? I had a CD that was paying 15% and matured. And they try to get me to roll it over into another 15% CD and say 15%. Yeah, I can do better than that somewhere else. Forget it. So that's what any of y'all take a 15% CD today? You would probably be jumping at that, right? So anyway, so she invests her 1340, so she's got 1340. Next month she invests, she makes $5. I mean, next month she invests. Excuse me. I got an error in my, just a second. Sorry. Let me take that out. Sorry, just a second. All right. So she invests 13. I'm going to show you what that $20 means in a second. So there she is. She's investing. She's kind of happy. Everything's, she doesn't really notice it. It's kind of depressing at first because after a couple years, she's got, 30,000 saved up. That sounds kind of good. But that's not even 1 year of income she needs. When do you get excited when you're investing? What's the first number that gets you excited? Not 100,000. 100,000 is pretty cool, right? You make 100,000 and the stock market drops the next month and you're back down below again. I might get excited about 250, all the round numbers. But 500,000 is kind of a nice number. She hits that in her 40s. She's thinking, man, I'm getting close to retirement here. But $1 million, everybody gets excited about $1 million. You never know if you have $1 million, does that make you a millionaire? You don't know if it's $1 million net worth or $1 million income. Her income's on $1 million, but her net worth's $1 million. But she's got $1 million bucks. That's nice. She's in her 50s. She gets up to age 62. She needed that 1.7 million, and she's there. She's got it. And then what does she start doing? She stops investing and she starts taking the money out. She's going along, and that's growing with inflation. Not 2% a month, but 2% a year, but I haven't grown a little bit every month. Doesn't look like it's much impact, right? Hardly even a pack. You say, wow, I could live to 120. But boy, that inflation starts catching up on her. She hits 78. It's like, well, I still got 1.5 million. Boy, this is gonna go forever and ever and ever. Uh-oh. Uh-oh. Now she's in her 90s. She's got 200,000 left. What do you do here? I would say, hey, you're 93. What if you're really, really healthy? And so I always think, I don't know exactly what the solution is, but she's got to find something that's a lot of fun, not expensive, and extremely life-threatening, right? I don't know if it's bungee jumping or what. It can't cost her too much. Maybe cocaine smoking, but that might be expensive. But she's got to do something that's going to go out, because she's going to run out of her money. Right there, she's done. She's done for. So is there a solution to this? And I'm going to give you a solution to this. So I'm going to take, I got to find out where it is. Let's see, B7 problem B, let's see, okay, calc A15. There's our 1360. I'm going to take $20 out of here. It may not work exactly. We'll see here. Yeah. Well, I'll tell you what we're doing. We're not going to take $20 out. Instead, what I'm going to do is I'm going to tell her, I didn't set this up right. but I'm going to show you anyway. Let's say she invests 360 and then she puts another $20 into this product I've created. It's called a longevity product. All right, so this is what I want to do at USAA is she invests 360, but we charge her an extra 20 bucks. We don't tell her that. So we tell her she needs to invest 1380. We kind of lie to her. The right answer is 1360, but we tell her it's 1380. And we take her $20 and we put it into a longevity product. All right. What this longevity product does is it invests in a product that says, if you're alive at 95, we give you all the money for everybody else in this product that died. All right. So how many 25-year-olds will still be alive at age 95? Not very many of them. So that means if Carol makes it to 95, she's going to get a big windfall. She dies before 95, she gets nothing, but she doesn't care because she's dead. All right. So that's kind of the nice thing too about investing. This is called a longevity product. So she invests her 20 bucks and goes along. Doesn't build up to all that much, but remember, she's got 5,000 built up in that 20 bucks, but so do all those other 25-year-olds in this product. And if they die, she gets their money. So that's kind of the nice thing going on here. So she goes along. So let's get over to let's get down to age 95. And what happens? 95. So here what happens is she gets this product, and this product will pay her $6 million. She invested $20 a month, and if she makes it to 95, she gets $6 million. If she dies at 94, she gets nothing. She dies at 95, she gets $6 million. Do you think she'll make it very long off of $6 million? Well, according to mortality table, the 100,000 people started at 25, only about 1,500 of them are still alive at 95. So she's getting a massive windfall from all of those people. Right? That's kind of the nice thing about that. So, well, she's got to make it to 95. If she dies at 94, 11 months and 30 days, she gets nothing. But that's why I like this product, because what are her kids thinking right here? That's our inheritance. Like, can you please just drop dead? What if she buys the longevity product? What are her kids thinking right here? Come on, you got to make it. So it changes the psychology of the family. I love longevity products. They're incredibly powerful things because you're taking advantage of people dying to help. And it's kind of opposite of life insurance. In life insurance, the people who die fast get all the money from people who live long. With longevity products, the people who live a long time get all the money of the people who died too fast. It's kind of a nice little. And I don't have it set up exactly right here because I'm using the wrong mortality table. So it doesn't quite work out, but it's in the ballpark. There's no question that this product, for a little bit of money, if you buy it young enough and let it go long enough, it's a massive return. It's really quite. But that means most people, 90-something% of the people, are losing 100% on that product, but they don't care. Same thing with life insurance, right? You buy life insurance at the end of the year, you didn't die, are you upset? No, you bought life insurance in case you died. If you buy longevity product and you die, you don't, you bought it as insurance, so you're okay with it. So everything in this spreadsheet, all these calcs are calcs that we use in this class. There's nothing unusual about it. The one big problem with this, or this particular assessment, is most people can't invest that much at age 25. It's just way too much. Most likely will start with maybe $500 a month or something, and that's going to build. So one thing I recommend, if you get a $5,000 raise, put as much of that into your savings as you can. What most people, I've had one student come back to me, he was like, what do I do, professor? He had a house he couldn't afford, he had cars he couldn't afford. So what do I do now? And I was like, it's just too late. He got a $5,000 raise, so he increased his living standard by about $8,000. It's just, it doesn't make sense. So if you get a raise, you should put at least half of it into your savings and just kind of keep your living standards the same. There's a real good trick in finance that we discovered. There's a guy named, I don't know if I'm Oh man, I may not be recording this class, sorry. I was recording it, but it's not, I didn't screen share, sorry. You'll at least hear it, but I'm not much you're gonna see. Sorry. But you have videos that show you how to do this anyway, so, sorry. That's the advantage of having more people in the Zoom, so. But anyway, there's a gentleman out there. Boy, I just lost my train of thought. I can't remember his name. Daniel Tversky. Oh, Daniel Kahneman. There he is. This guy right here, he has a TED Talk that's really, really good. You should find it. It's on happiness, but he's talking about contentment, and a lot of it has to do with finances. There's been many studies. He's somewhat the guru on this. Very, very smart guys. He has some great YouTubes out there as well, in addition to his TED Talk. But I would highly recommend you look at his TED Talk, because economists think happiness comes from our level of wealth. And Kahneman says that's not true at all. Happiness comes from the change in our wealth. It's not the state, it's the change. And if you want your life to be very content, then you don't get the level where you want it, you increase the number of changes. The more changes, the happier you are. So the students I have, they go from the $20,000 car to the $80,000 car. What have they done? They just eliminated like 5 stages of happiness. They would have been better off going 20 to 30 to 40 to 50 to 60 instead of 20 to 80. 20 to 80 creates a little bit more happiness than 20 to 30, but only one time. If you do 20, 30, 40, 50, and he talks about it, it's the change in the state. And just to give you an example of that, let's go back to Mary and John. They both start with, say, $100,000. At year 1, Mary has 140,000, and John has 2.2 million. And then at year 2, Mary has 170,000, and John has 190,000. Whom do economists say is the happier of the two? No, who do economists say? John. Why? He has more wealth. Whom do you know is happier? Mary is much happier. Why is she happier? Has to do with the change in the state, not in the state itself. That is such an incredible secret to happiness. And I always tell students, if you're making $80,000 a year, don't live in a neighborhood where the average pays $80,000. Go to a neighborhood where the average pays $40,000, and you'll feel rich. If you're making $120,000, move to a neighborhood where the average is $80,000. You'll feel like you're rich. If you're making $500,000, move to a neighborhood where the average is $200,000. I remember reading a story of this lady. She was so mad. Her husband made $1 million, and they felt so poor. How can you feel poor if you're making $1 million? Well, they're living in a neighborhood where the average pay was like 1.5 million. And they felt so poor. If they just moved to a neighborhood where the average pay was 600, she would have felt rich if they moved somewhere. So it's really key when you're talking about these type of things is understand the economists really have studied these quite a bit. And there are secrets to this that you can make your life much, much more pleasant just by doing it. But I do recommend watch his TED Talk. He's very, very good. The riddle of experience versus memory. And what he's saying there is happiness is all about memories. It's not about experiences. You're not happy because you had good experiences. You're happy because you have good memories of experiences. And memories are based on change of states. In fact, you should move as many times as you can in your life because you'll remember your life a lot better if you do that. And he gives an example of that just to prove it. He says, I'll give you a 2-week vacation. I'll pay for it. You can do whatever you want to do. Fully paid. You want to go take tennis lessons with John McEnroe, you can do that. Any trip, anywhere in the world, 2 weeks, all paid for. There's only one catch. When you get back, we're erasing all your memories of that trip. Where do you want to go? What would you say? Most people say, I don't care. Why? Because without the memories, the experience is useless. And so he says, if you're going to make your life really content and really happy, you got to focus on memories, and memories are tied to changes in states and changes in experiences. Same thing with wealth. It's the change, it's not the levels. Don't shoot for the level, shoot for the changes. But it's a really good talk. He's a really good speaker. He's a Nobel Prize winner. He's the only Nobel Prize winner in economics that's not an economist. I mean, not in economics. He's a psychologist, but really good speaker. He knows finance very, very well. All right, so sorry I didn't get that, but trust me, on the stuff we did today, it is on the YouTubes. All right, so where are we going from here? Let me just, you need to finish up your papers. So they're due, I think I said Sunday, right? I gave you a couple extra days. If you need to meet with me, this week's a little rough because I'm getting this investment society set up. So if you come down there, just let me know you're there. I may have to sit in the room for an extra 5 minutes. You can call me, those kind of things. As far as the Excel applications, don't worry about them until we get this paper one done, because trust me, it's going to be pretty straightforward. So, all right, I'll let you out a little bit early since we got paper coming up. This is a good practice for your paper and for the exam. So it's good practice. Even though the exam won't be multiple choice, it still shows if you're catching on. So, all right, let's start with this question. Abbott Labs times interest earned. They're the blue. Medtronic, their ability to repay their debt has deteriorated significantly since 2014. But has been improving since then, and in 2009 is now strong given it surpasses 10. Their ability to repay their debt improved significantly from 2014 to 17, but has deteriorated since, so A and B are just the opposites. C, their time interest earned peaked at 30% in 2014, but has deteriorated significantly with only minor improvements since 2017. Abbott Labs has consistently been in a much weaker position than Medtronic and its debt levels and needs to find ways to get this ratio back below 10%. This is times interest earned, all right? So talk among yourselves. All right, give you 30 seconds. It's one of those questions, you either know it or you don't, kind of thing. As a team, I need you to submit it. Yeah.
I do remember it has like time.
Oh, wait.
Each member of the winning team in this semester gets $10,000 unless I change my mind later. All right. Anybody want to take this one? Anyone take it? A, B, C, or D?
It's C.
I think it's C. All right, so one thing on times interest earned. So this is important in your paper and on the exam. What is wrong with C? C is not the right answer. It's real close. I mean, Matthew, it's real close, but what's the problem with it?
It's a percentage.
It's percent, yeah, yeah, times interest earned is times, it's not percent, all right? So don't use percent on your paper. So, but Matthew, you're right if you're taking the percent off, because that would be A, right? So it's gotten worse, going down is bad. So I heard this team over here saying, is higher better or lower better? That's the kind of question you got to know for the exam. So lower is worse, higher is better, but I gave you a rule of thumb on this one. 10 is generally considered a very strong number. If you're above 10, not an issue. So yeah, they deteriorated, but they've improved significantly since, and they're above 10. So their ability to repeat deteriorated, but has been improving and is strong given it surpasses 10. All right. See if I'm right. Yeah. Let's try 9. Now this is debt to EBITDA. All right, the first one was times interest earned. This is debt to EBITDA. What can we conclude about Train's solvency? Their ability to repay their debt is right in line with the industry. Train is the blue, the industry is purple. Their level of debt appears reasonable compared to industry, but weaker in 2019 than Johnson Controls. Their level of debt appears reasonable compared to their industry, but stronger than Johnson Controls, a key peer. Train's level of debt is much more volatile than Johnson Controls, a key peer. All right, so I'll give you about a minute. Now, a key here is their ability to repay debt versus their level of debt. All right, so I gave you times interest earned and debt at the dollar. Which one measures your ability to pay debt and which one measures your level of debt? All right, so that's part of the trick here. Level of debt versus ability to repay debt. All right.
$5 billion. That's interesting.
Now you want to see question 8 again, right? See how I worded that? All right, 30 seconds.
Yeah. Well, only one. Can you show us
All right, so what do y'all think? All right, your ability to repay debt, is that times interest earned or is that debt to the dollar? That's in times interest earned. So anything that says ability to repay debt, you throw that out. That's times interest earned. All right. And why is that? Because debt to EBITDA doesn't really tell you if you can repay your debt. It's telling you how much debt you have. So their level of debt, level of debt, level of debt. So the other three are possible. Now, the weaker or stronger, I actually told you on paper, when you get to the financial leverage and debt, to try to avoid the word weaker or stronger. I somewhat violated that here, but higher is better or worse here? Higher is worse here, all right? So compare the industry, but weaker in 2019. That looks like that could be true, right? Because they're above them. Their level of debt appears reasonable, but stronger. You know, you never say stronger because they have more debt. You would say weaker. I should have used the word stronger and weaker. And is their debt level more volatile than Johnson's? Can you tell? Which one's more volatile? Johnson's, yeah, by quite a bit. So what are y'all down to then? Yeah, B looks like the right answer. Stronger and weaker. Avoid those terms when we talk about debt. And you'll see why later when we talk about Miller and Modigliani. We don't generally talk about high levels of debt being weak and low levels being strong.
Yeah.
But I do agree, higher debt is a bad thing. So, all right, let's see if I got it right. Yep. Okay. Here's the probability of default. This is Ecolabs, one of my favorite companies. They are one of the weakest companies in the industries, given their very low Bloomberg solvency score. They're right there. It would be reasonable to assume Ecolab's credit rating is lower than Lyondell's. It is usually best not to consider external assessments of solvency, such as this ratio or a credit rating, as agencies that produce this measure have strong bias that make their scores unreliable. Ecolab is one of the strongest in the industry and likely has a higher credit rating than Lyondell. All right, so again, is higher better or lower better? What is this? The probability of default. All right, so you start with that.
You don't want it.
So
the probability.
Oh.
You want it.
Oh, okay.
Lower the better.
30 seconds. All right, so what do you think about C? What are you doing on your paper? Y'all ignoring credit ratings and probably default in your paper? you're including them, right? So obviously I disagree with that. I actually think it's really, really good to have an X. I mean, isn't that kind of nice? Do they have biases? Rating agencies have biases, but actually if you look at their data, they're incredibly accurate. AAA companies go insolvent far less frequency than triple B companies. So I would kick out C. Are one of the weakest? There's the best 10%. There's them. They're actually one of the strongest, right? So you wouldn't think their credit rating would be lower. Think it'd be higher than Lyndale. So which one does it look like? D. All right. So. All right, let's do a couple more. We might do some on Tuesday as well. So revenue per square foot, Advanced Auto Parts, another firm I like a lot, versus O'Reilly. What can conclude about this? They have done a good job keeping their revenue per square foot below 250. Revenue per square foot is a good measure of margins for a firm like Advanced Auto Parts. They have been very stable, but falling behind O'Reilly since 2015. Revenue per square foot is a good measure of solvency for a firm like Advanced Auto Parts.
Yeah.
Oh. Alright.
Okay, so what could cause it? Either increase employee or decrease revenue.
No.
Decrease it.
All right, 30 seconds.
Decrease revenue or increase the revenue. That could change. I thought that was the case with store, wasn't
That's what I'm saying.
All right, let's see. First of all, is higher better or lower better? Higher is better, all right? What does revenue per square foot measure? Does it measure solvency, liquidity, turnover, or margin? It's a turnover ratio, right? It's not margins, it's not solvency. So you can kick out B and D. So what are you left with? C. Very stable. You want it stable, you want it rising, but stable is better than all over the place, definitely. But very, very stable, but has fallen behind O'Reilly here. So C looks pretty good. All right, y'all want to do one more? One last one. Here's a revenue per employee. Honeywell is the blue one. Here's Honeywell right here. Here's the industry. Here's 3M. There's the best in the industry. This is the revenue per employee. They have both, we're talking about Honeywell and 3M in this one. They have both been industry leaders in this asset turnover ratio. Revenue per employee is a key measure of gross margins for these firms. Honeywell has been the more consistent company, maintaining its revenue per employee, but 3M has been showing the strongest improvement. Revenue per employee is a good measure of liquidity for these firms.
Can't be because but is 3M the one being consistent rather than the other?
Yeah, 3M is very consistent.
So I can't be C either.
All right, 15 seconds. All right, so revenue per employee is that Liquidity, solvency, turnover, or margin?
Turnover.
It's a turnover ratio. Anytime you see revenue per, that's a turnover ratio. You just know that, right?
Mhm.
Margin ratios have the what word in them?
Margin.
Margin. So is gross margin, what does it measure? Margins, right? So that's kind of your advantage. Turnover ratios have the word revenue in it. So a margin is something divided by revenue. A turnover is revenue divided by something. So you can kind of keep that straight. So it's not a measure of gross margin. Who's been more consistent, Honeywell or 3M? Yeah, 3M. 3M's are much more stable, so that doesn't work. It's not a measure of liquidity. So which one do you think it is? Very first one. All right, good. Okay. We might do a few more of those on Tuesday. Okay, so what we want to do, since you're in your teams, let's stick with the teams and where we're going next is capital budgeting. Let me tell you what capital budgeting is, and then I have a team exercise for your project 2, which you don't want to think about yet because you're still in 1, but you want to at least be thinking about it. But what is capital budgeting? Why is this such a huge question on interviews? And this really is one of the biggest things management does, is they decide, where are we going to invest our money to make the firm better? Capital budgets. Capital meaning it's something we're going to invest in that's going to have a long life. It's going to last a long time. Machineries, buildings, those kind of things. The ones you'll see, you might be an IT major or a cybersecurity major. You're going to be involved in cost benefit analysis. You may be developing them, but you should know what's going on. So they're going to ask the question, hey, do we build this software ourselves or do we buy off the shelf? We had a lot of those debates at UTSA. Can we build it ourselves or off the shelf? I remember we had a bunch of people in our IT area. They weren't actually employees or contractors. We were going to build a new model for our internet for financial planning. And I said, I'm just going to buy something off the shelf. And no, this one guy, he was so disappointed. He was ready to go. He wanted massive software. I said, no, we're just going to buy it. Should we try to improve this product or should we get rid of it? Early in my career, I was like 6 months into my career, the CFO comes to me and says, and this is how he expressed it. So this is actually really important to your project. He said, Ron, I hate our health line. I want to shut it down. Go do an analysis so I can shut this thing down. Did he have any bias when he told me what to do? Right, he already told me what conclusion he wanted. So I went and did the analysis, and what I discovered was my good friend Cindy, who did cost allocation, was allocating a lot of costs to the health lines because they had a lot of employees. And a lot of her cost allocation, have y'all taken cost allocation yet? That's activity-based costing. A lot of her cost assignment was related on employees, and the health line, especially the disability line, had a lot of employees. So the analysis I did was, well, if we shut this down, would our income go up or go down? And what I discovered, if we shut our health lines down, our income would go down because they were getting allocated so many costs. What happens when you shut that line down to all those allocated costs? They got to go to everybody else. So I go back to the CFO and say, hey, if we shut this line down, we're actually going to lose money because if you just look at their actual direct costs, they're actually quite profitable. And so my friend Cindy, she fixed it. She just took a lot of the costs and shifted over to the life products that never complained about anything. Suddenly it became profitable. But he gave me this pretty biased request, but when I got to the end of it, it looked pretty good. So it really wasn't an underperforming product. If it is underperforming, you can actually sell it to another firm. That's possible. You don't have to necessarily just shut it down. You're going to buy another business? Should we merge with another business? Should we introduce a new product? What happens to our competitors if we do that? How are they going to respond? Outsource, insource? This is, there's some pretty good Dilbert cartoons, firms that outsource something and then 3 years later they bring it back in-house, and then 3 years later they outsource it again, then it's back in-house. Just back and forth is like this yo-yo. I had a big project at UTSA where they decided to combine all the CFO areas into one big department, and they're still doing that today, so they didn't go back. But they decided the life insurance company doesn't need their own CFO. The property and casualty doesn't need their own CFO. Let's just combine them all together in one big department. My department combined all the cash handling people Good old Carol Walls was doing cash handling for PNC, and she said, I can do it for everybody. The other entities, guess what they said? It's like, no, we need control over our own operations. If we send it to PNC, they're going to do their stuff first, and they're going to leave us out in the cold. And we actually didn't do that because the property and casualty was getting checks for like $500 or $600. The investment company and life insurance company, they were getting checks for like $100,000, $200,000. So no, we did their checks first. So that was a big project. And in that project, I discovered that if the cash handling people came in at midnight, we could hit an earlier deposit date and we could get our money one day earlier. I wasn't recommending that. I was just mentioning that if they came in at midnight, and Carol told me that they had my picture up with a dartboard. And I was like, no, it wasn't my recommendation. I'm just pointing out the facts. But yeah, firms do that. How do we structure our firms so we can do same work with fewer employees? And what happens to your revenue per employee when you do that? Goes up, right? You become more profitable. So that was a centralization function. An efficiency project, which is a pretty common one. Can we do something that's, maybe HEB, it says, inventories, our employees hate doing that, it's expensive. Why don't we just have robots come in and do our inventory from 2 a.m. to 6 a.m.? They don't complain, they work nonstop, they're very, very accurate. Why not? So maybe HEB is doing that. A marketing project, some of you marketing majors, a marketing project, how much extra income will we get? What's the reply rate? Those kind of things. What would a competitor do? Risk management initiatives, I did a bunch of those at USAA. Those are really tough to do because a lot of times you're spending a lot of money in case something really rare happens, like a major hurricane or something. If it never happens, that you waste your money. If you buy homeowners insurance and your house never burns down, was that a bad decision? It was certainly if you'll never have a claim in your life, would you buy homeowners insurance? Probably wouldn't want to, right? It's a waste of money. So risk initiatives are kind of tough because it's hard to do a cost benefit analysis because you're talking about something that may never happen. Tax saving opportunities, there's a bunch of those. And some of them are really bizarre. The IRS, how many pages is the tax code now? Is it like 10,000 pages? Something crazy. We had a firm come to us. There's a law passed that if you treat coal, you get this huge tax advantage. And we could buy that from other companies. We could actually buy their tax credit from other companies. And a company came to us and said, yeah, we treat coal. We'll sell that credit to you. And that was a massively positive project. We could have made a lot of money doing that. But why do you think Congress wanted to subsidize people treating coal? What were they trying to do? Help the environment, right? But they forgot to write in the law what you did when you treated the coal. All they said is you have to treat the coal. So these companies were literally spraying stuff on coal that had no impact on the environment and getting a huge tax benefit for it. So here I had this project that was definitely very positive, beneficial. We never took it to CEO because we said, even though it's beneficial, the headline risk is horrible. We don't want USAA evading taxes and doing something we knew was not good. But yeah, there are things you can do purely for the tax reasons. And the IRS sets those up. New collection strategy, can we get our money faster? Expand as significant resources on a new website. Business decision support tools. I did one of those, it was $300,000, and they asked me, well, what's the benefit side? And I said, well, the benefit is we'll make better decisions. I said, well, how much is that worth? Well, that depends on what decisions we make. Like, well, we need a number, It ended up saving us like $3 billion in 2008 alone. So it kind of paid for itself, right? You pay 300,000, you get 3 billion, that's kind of nice. But then they had to make a decision, do they renew it? And they said, well, what's the benefit? I said, well, you got 3 billion last year. I said, yeah, but what are you gonna get next time? It's like, it depends on this. And they decided not to do it. Then they decided to redo it. And I saw that department. I talked to that department. When we did it, we had like 2 people. They have like 70 people doing it now. So they decided not to do it. And then they decided to go way overboard and have 70 people do it. So, these are decisions firms are making all the time. Some regulatory requirement. How do you apply that? So those kind of decisions you're going to make. So when you get your project for your team, you need to pick a project. So what I want to do today is get you, we're not necessarily decide what you're going to do as a project, but I want you as a team, since you're all together, to start the conversation. All right. So what I want to do is give you some ideas. Very, very, very key here. A few things you absolutely have to do. I don't know what that was. First of all is what we mean by a project here, all right? You have to make sure you pick something like this. I'm going to be real picky. You have to get your project approved in advance. We've had some projects that were so horrible, and I just knew going in it wasn't going to work. And the team's like, no, 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 we think it can work. And at the end, they're like, boy, that was a disaster. And I'm like, so I'm going to be much more hard-nosed this time and say, I just know that's not going to work. So one thing is you have an investment at time 0 followed by net benefits. All right, that's real important. You're spending money today to get some future benefit. All right, we'll talk through what those are, but it needs to be something along those lines. Some can be a little tough, and I can kind of finagle them. So some people say, I want to look at the cost benefit of getting a graduate degree. Well, if you do a graduate degree, you don't pay for it all up front usually. You usually pay it over a couple of years, but I'll sometimes say, you know what, well, let's just assume you pay it all today. That'd be close enough. So we can kind of get around that, but you need something where you're making an investment today. We'll talk about what those are. It's got to be something you're interested in. Don't already know the answer. All right, so that's important. I want something you're curious about. And we'll see what those are, but don't pick something you already know. Yeah, I'm obviously going to do that, but let's do the numbers anyway. One, I had at USA, which they would not let me touch this thing, but boy, I wanted to do this. I wanted to see the net present value or the benefit of USA's corporate jet. Do you think that's a positive net present value or a negative? Corporate jet kind of sounds like a boondoggle, right? Sounds like that. Boy, they use that jet really, really well. We were on it all the time. I've had several groups have done corporate jets as a project, and it works actually pretty well. And Constellation Brands did it, a team did it, because they were going back and forth between Mexico just constantly with really high paid employees. And so I was just interested. Does it make sense? It saves you a lot of time. It saves you obviously the cost of commercial, but it's going to cost you more to fly. So you look at those kind of things. So I didn't want to do that project because I was sure it was bad and I wanted them to sell their jet. I was like really, really curious. What is the net benefit here? So I want you to do something you're really, really interested in. You need to be able to forecast. So you need some sources for assumptions. That's really important for your project. Some projects are much easier than others. So one good project to think about, which at least one team will always do, is some kind of franchise. I want to open a McDonald's. I want to open, don't do Chick-fil-A. Chick-fil-A doesn't work. They're really bizarre. Subway works, but boy, Subway doesn't meet the second one. I can already tell you Subway is not you can go to YouTube and type Subway franchises, and the first 20 will be why you should not open a Subway. So it's very negative. So you have to have some way to get assumptions. I've had some cases where that just wasn't possible. I had one student, she was from China, and she wanted to do the cost benefit of the China Olympics. And I said, I don't think you can get the assumptions, but she said, I can. And she did a fabulous case. It really was quite phenomenal what she did. I've had others. One I'm really interested in that I would love to do is drug policy. Should we be putting drug users in jail? So the project was, what if we don't put them in jail? Instead, we pay for rehab. We don't put people in jail. What would that look like? Sounds like an interesting project. I thought it'd be pretty cool. So I called the Cato Institute because they do a lot of studies like that. And they sent me all over the place and they said, no, we've never studied that. It's like, I can't believe you've never studied that. I had a team try to study it and they just could not get good data. It was very, very, very difficult. Great project, very interesting. I'd really like to know the answer. I mean, it's pretty tough, right? It's pretty expensive to put someone in jail. Rehab's expensive as well. And then you don't know how how successful that's going to be, how many people are actually going to be reformed. So it's an interesting project, but the data just doesn't exist, so it doesn't make a good project. And can't be too complicated. So here's where I've had problem. Boy, I had this problem with my graduate students last semester. Oh my word. They picked a project because one of their team members had a lot of background in that area. He was the only person who understood the project. I don't think he really even did. It's like he could tell the teams like, we don't know what that means. We're not, and it was just so frustrating. So you don't want to pick something that is too one team member focused. All right. Pick something the whole team understands. Okay, make sure you all know what's going on here. And there's plenty of example here that would fit into that. If you do that, you should have a good, interesting project. And the reason you want to start thinking about it now is that a lot of the research will just drop in your laps. So if you're doing a project on electronic vehicles, then you see a great CNN story or a Wall Street Journal story on that, you can pull that and make it part of your case. And you're just kind of doing research as you go, just naturally. So it kind of helps. So questions on that. This is really, really critical that you pick a case that fits. Now, I mentioned franchises. I don't want 3 teams doing McDonald's franchises, but franchises are fine. Every franchise is different. So if one wants to do McDonald's and one wants to do a, boy, there's some of these last few years that have been really fascinating. What was the one? It was a Smoothie King. Is that one? I think a team I've never been to a Smoothie King, but they might sound one. I mean, I really wanted to go Smoothie King after the case. That it sounded like a really fascinating franchise. The way they ran it was really interesting. So, those can always be interesting. They work well, right? Because you have to pay the franchise fee up front. That can be a few $100,000, and then it's a business that has an income.
I'm pretty sure there's a Smoothie King in Korea.
They said there was some around here. I
It's like right next to Chick-fil-A in Korea.
don't know where that is though.
It's right underneath the JPL.
Oh, JPO. Okay. Yeah, I have to try it one of these days. I've done, what is it, orange leaf or some of the others, or Jamba juice and those kind of. I mean, they're good, but as I'm drinking it, I'm going, this tastes exactly what I can make at home. So it's not all that special, but we'll see. Smoothie King might be really good. All right. So let's give some examples. Some I like, some I don't. Okay. Solar panels. You've seen some solar panels here in San Antonio. Does it make sense to put, $10,000, $15,000 down on solar panels? Can you save enough electricity? I'm getting bored with this case because so many teams do it. If you do this case, you really have to set up really 2 cases. San Antonio, I don't know if y'all realize this, but electricity in San Antonio is a lot cheaper than almost anywhere else. So a solar panel in San Antonio is not nearly as beneficial as a solar panel in Austin. So you almost have to contrast those 2 because it is pretty big difference. But that's one. The nice thing about this project is there's like a million websites out there to give you all the data that you need. It's pretty straightforward. The challenge is going to be you're going to have to pick a house. It's hard to make solar panels generic because it depends how the house is facing, what city they're in. There's a lot of things there, how much electricity they use, but that one can work. Oh, one other thing I should have added here because I just saw that. Need good intangibles. I think of there's one other I want to add, and I can't spell intangibles. So you need some intangibles, those things that are not in your project as far as dollars, but they're important. They're kind of I'll give you some examples as we go here. I mean, solar panels, the intangible might be, it just doesn't look good on the house, the aesthetics, and it's hard to put dollars to that. So we'll talk to that. And then the other one is you need good sensitivity analysis. That's the other one. You need something that you can test because you're unsure about it. So if you're going to do an electronic vehicle, maybe your uncertainty is gasoline prices. Right. So I bought a Prius Prime in December 2019, and then it sat there for 2 years, and I hardly drove it. Didn't really save me all that much gasoline. I think I put 6,000 miles on it in 2 years. bought 1 gallon, I'd fill up my gas tank one night. Well, this year is kind of nice. Someone on Facebook was complaining about putting $100 of gas in his truck. And I at the convenience store, I said, what's a gas station? I don't ever go to those places. I don't know what that is. Because I never do buy gasoline. So now it feels pretty good, but for 2 years there, I really didn't get any benefit at all. So on that one, what was the sensitivity analysis? It might have been miles driven. I might thought, I usually drive 10,000 miles per year, and then COVID hits and I'm driving 2,000 miles per year. So that has a big impact. It could be gas prices. Gas prices when COVID hit did what? Fell dramatically, right? No one was buying gasoline. And then now suddenly, because Putin's really helping us out here, gas prices are much, much higher. So those are things I could test and kind of see, how does that have an impact on my project? The things you're most uncertain about. So there are some projects that are really good projects, except for there's just no good intangibles, or there's nothing you can really do sensitivity analysis on. So you might have 3 projects you're interested in, and those 2 things might be the deciding factor to give you something really to sink into. And when you read some of these analysis, sensitivity analysis should probably focus on the percent of annual utility bill that can be replaced by the solar panels. Purchase an electric or hybrid car, electric vehicles. Right now, I think this still works, but it's getting tough. You have to have an investment at time 0. So you can't do an EV if an EV is cheaper than a gas car and it saves you gasoline. Because then you're saving money at time 0, and then you're saving money in the future. Everything's a positive cash flow. But if an EV costs more than a gas car, then what's your cost up front? You don't do the cost of an EV and do a CBA, and then you do a cost of a gas car. I know how to spell do. You don't do that. That's not your case at all. So what is your case? Your case is, let's say the EV, oh boy, I hate Bill Gates thinks I want bold everywhere. EV costs, say 35,000, comparable gas costs 30,000. What's your case? Your case is, should I invest the additional 3,000 today to get the savings on gasoline? And I have to say the net savings. All right. So your question isn't, do I spend 35,000 on the EV? Your question is, do I spend this extra $5,000 to get an EV when I would have bought a car that was cheaper? And why do I say net savings? Well, because electricity is not free. It's cheaper than gasoline, but it's not free. So you're going to take the savings on gasoline minus what you extra that you spend on electricity. I so far have not noticed a change in my electric bill. So it feels like I'm getting my car for free. And my Prius Prime gets about 35 miles a day, and I drive about 25 a day. So I just never buy gasoline unless I have to travel to Houston or something. So, but I haven't noticed my electric bill has not hardly changed at all. So it feels free, but I know I'm probably saving $100 in gasoline a month, and I'm probably spending an extra $8 to $9 on electricity. I'm probably netting about $90 a month, but I'm not 100% sure. It's a hybrid, so yeah, it's gas and electric, but I've only filled it up. I've had it for going on 3 years, and I've gone to the gas station twice so far. I feel it. That's only because I had to drive to Austin and back twice. I had to drive to Houston and back. So I've filled up twice, and I still have 3/4 of a tank left. So I just haven't. I mean, I put maybe I think 7,000 to 8,000 miles on it. I've only been to the gas station twice. So yeah, it's perfect for me. I just don't use much gasoline. Now that's not an EV. That's a hybrid. But I could say, should I have spent an extra, maybe an extra 3,000 on a hybrid versus just a gas car to get the savings? So it's really important that in time investment, it needs to be stated real clearly what your project is. There, the question isn't, is the net present value of electronic vehicle positive? All cars have a negative net present value for the most part. The question is the additional amount worth it? All right. Open a franchise, those are always good. What I love about the franchise on most franchises is it's really amazing. And this may be one way to test it is to go to YouTube and type in your franchise and you'll be amazed what comes up. There are actually people on YouTube that their whole goal is to walk you through how to do a franchise. What are the numbers? What are the intangibles? They talk about the intangibles. You know, that's the thing with Subway is, yeah, the present value is positive, like $50,000. But $50,000, that's a lot of work for $50,000. If I'm going to be spending 80 hours a week, you know, because some employee doesn't show up or there's some pipe burst and I got water everywhere, or I got a customer show up and they're all angry because they want, you know, 500 sandwiches and they can't do it. If that's going to be this constant headache, it's not worth $50,000 for me. I'll go do something else. And that's the team who presented Subway a few years ago. They said, yeah, it makes sense. It's a good franchise. I'm going $50,000. Yeah, I can find better things to do with my time and my life than for $50,000. The Smoothie King looked pretty interesting, a little bit higher. And that's what these YouTube videos do is they really say is, yeah, maybe you're going to make money, but you're making enough for it to be worth it. And so most Subway owners do what? They have 5 Subways. But even then, they're only making $200,000 a year with an incredible amount of work. Well, my frustration in time, yeah, that's an intangible, definitely. If you know, if I'm spending 40, 50 hours a week doing this kind of stuff, yeah, it's frustrating. I was talking to a Chick-fil-A owner, and Chick-fil-A is hard to do because Chick-fil-A's are definitely very high positive net present value if you can get one. But they're real picky whom they give a franchise to, so it's almost impossible to get one. But he and his wife, boy, they put a lot of time. I was shocked on Chick-fil-A how much time they spend on each employee that they're hiring. You would think some minimum wage entry level employee, you know, McDonald's, it's like if you can write your name on the application, it's like, okay, you look like a good employee here. But they went through a series of interviews like that. You know, this is Chick-fil-A, right? But I don't know if HEB does that. You know, Chick-fil-A and HEB have a reputation for really good employees, real friendly, but maybe that's the process. Driverless cars. Now you can't do that because we're not doing it yet, but I have had, this is one, if I work for USA, this is a project I would do to say, hey, USA, if driverless cars, autonomous vehicles come around on say 2030, such that people no longer buy cars. So instead of buying a car, you just get on your Uber app and you say, I need a car. The car comes up. There's no one in the car. You know, what happens to Uber with autonomous vehicles? About 70, 80% of Uber's cost is the drivers. Some of y'all might be Uber drivers. What happens to Uber instead of it costing you $30 to get to the airport, it only costs you $6. Would you ever buy a car? Would you ever need a car? So what happens to USA if it doesn't make sense to buy a car ever again? So I thought that'd be an interesting one. I had one team not do this for driverless cars, but do it for autonomous trucks, because we know, not just because of Canada, but we know there is a huge shortage of truck drivers. And there are companies out there that are experimenting with driverless trucks. The nice thing about it is it might be safer for the rest of us, because if you can have a truck that can drive 24/7, then you can have a truck driving 50 instead of 70. You save a lot on gasoline. You can also do a lot more electronic vehicles because you don't mind them stopping to get refueled for an hour or so. There's a lot of benefits and tangibles in there that make sense. This is one where the data is available. There's some good articles out there. The question is, you know, you can't do it now. So when will it be available and that kind of thing. But I would think if I were USA, if I was Valero, I'd be really worried about the electronic vehicle. If I was USA, I'd be worried about autonomous vehicles because it could certainly harm them. A few on the real estate side. So this is one project I've seen is, let's say you're gonna have a kid going to college and they want to stay in the dorm, and you say, you know what if we buy some old house in the neighborhood? We let you stay there. 3 of your college buddies can stay there. They pay rent. Instead of the dorm, we'll do that. We're not going to fix it up because college students are going to wreck it anyway. You'll stay there for 4 years. At the end of 4 years, we'll refurbish it and we'll sell it. Would that be cheaper than putting you in a dorm? Would you rather be in the dorm or a house? house would be more freedom. You mean, you have to travel back and forth to campus, right? So, there's some issues intangible wise. So I've had a few teams do that. And a related one is rather than buying your first house, and I'm actually not a big fan of real estate. I don't think people in their 20s should buy houses, but I know a lot of my students do. But rather than buy a house, buy a duplex and lease out half of it and try to get the cost of home ownership down. Would that be better? Not than buying a house, but would that be better than renting an apartment? Did you come out ahead doing that? Corporate jet, just talked about that one. I've had a few do this, any kind of kiosk. One team last semester is really interesting. I see two of them. One did a kiosk for HEB from the pharmacy. What if instead of having people online, they just go to kiosks? And another team did it here, and I don't know what UTSA is doing because of COVID, but a kiosk for like the food court here. Are they doing that now? So a lot of colleges are. I didn't understand why a kiosk would be better than just ordering on your phone, but they talk about the advantage of it is if you can get people off of the cashiers and have more people preparing the food, it just makes it more efficient. We had some doctors do a kiosk for office, and I've seen that when you walk into the doctor's office, there's no one there to greet you except for a computer, and you just type everything in. So that can be interesting. This tends not to be as great of a project because some of them are just so obvious because the cost is really low and the benefit's so big. It's like we spend $3,000 and then we get $5,000 in benefits in the first month. It's like not all that interesting, right? It's pretty obvious you should do that. Yeah, kiosk. All right, so this is one I was talking about, social spending. We had one team try it on the drug use. Let's don't put people on gel. Let's instead pay for them to go to rehab. It is a tough one to do, but there may be better ideas out there. So this guy, his TED Talks is probably the least popular TED Talk in the history of TED Talks. I thought they were gonna start beating him up. It was like, wait, just hear me out. I think he said, just hear me out like 4 times. But I love what he's doing. I've heard him in a podcast before. He's an interesting guy. He's controversial, but he's controversial because he asks questions people are scared to ask. He's not asking it because he doesn't think global warming is important. He's asking it of, okay, we're going to spend trillions of dollars in global warming. Is there a better way we could spend that money, global warming, and we're better off 100 years from now? Is that an unfair question to ask? Is it okay to ask that question? That's what he said. Can we at least ask the question? And so he set up, here's his TED Talk, but he set up this, here's his econ talk. He actually has, I thought I gave you the link. Here, I think that's the TED Talk. He has a link. He set up a group where they have all these global social issues, and he talks about cost benefit. So other than COVID, what's 2 things that kill more people? Anything else?
Accident.
Well, accident is an important one, but tuberculosis is a major one. In fact, tuberculosis is, in fact, COVID may mean more people die from tuberculosis because they're not getting the tuberculosis treatment. But tuberculosis and malaria, and then AIDS as well. So those are the 3 diseases that are just killing a lot of people. You mentioned accidents. I mean, this will be an interesting project. A lot of pedestrians get killed by cars because a lot of cities don't have curbs. That seems like that would be an expenditure. It would make a lot of sense from a social. So that's what he does. I'm not recommending him but he's an economist, and he asks those questions. Would we be better off if we spent money on tuberculosis and malaria rather than on global warming? How many people would be better off 100 years from now if you did that? And then he said, well, some people say there's a chance global warming completely destroys the entire planet, we all die. And he says, yes, there's a probability of that, but there's actually a higher probability we get hit with a meteor that destroys the entire world and we all die. So global warming has a 0.001% chance, but a meteor has like a 0.1% chance. So maybe we should be spending trillions of dollars on something to shoot meteors. That's the kind of questions he's asking. I don't know where he gets his data from, but anyway, that's a controversial one. I love controversial things. Be careful on this one though, because I don't want your team like fighting, having big debates and y'all can't get anything done. All right, this one I really loved. The team did it last year. This team, they had a cybersecurity person on their team, and he took up everything. He was in charge. I've been really recommending that student. It's like, wow, he's not even a finance student. He just completely took charge of his team. But they did this project. I think here, one thing I would really give you extra points for is if you made it as real life as possible. So, one thing I find interesting, go find some restaurant owner on I-10 who owns the restaurant and their parking lot and go to them and say, hey, what if you put a Tesla recharging station in your parking lot? And while people are having lunch at your restaurant, they can be recharging their cars. You get more business. You could even have some kind of discount or something when they come in. It's just sitting there, right? You're making money off of it. I think that'd be a pretty interesting project. Do you think there'd be a restaurant owner who might find that kind of intriguing? That would be kind of interesting, right? They never have all their spots taken anyway. Why not use that? So I think that'd be interesting. The downside, you gotta be careful on this, is Biden is talking about all this infrastructure spending on making more of these stations available. So maybe you're competing against the government, which has some pretty powerful monopoly power. Prison versus rehab, I really don't recommend that one just because it's so hard to get. This one I love, and I haven't had anybody do it, but urban vertical farms. Have y'all seen this stuff? It's so fascinating. Like in New York City, you got 4 floors of a building, and it's just growing vegetables, fresh vegetables inside a building. No, I can't think of where herbicides or whatever, killing insects, don't worry about the insects. It's just an amazing thing. And there are articles out there. I'm going to give you a link to an article. Here's an article here. Vertical farms are growing more and more vegetables in urban areas. You could set it up. It's going to cost quite a bit of money, but you have deals with local restaurants where you're providing them fresh fruits and vegetables. I mean, I think it's a really amazing thing. You might say that just sounds so small, but I mean, some of these are, 2 acres of vertical farms is going to grow a whole lot more than 2 acres outside, because it really is stacked on top of each other kind of stuff. So I find it really fascinating. China plans to build entire neighborhoods around vertical farming. Most vertical farms share a few attributes: lack of soil, meaning the roots are fed with nutrient-rich mist, or I can't read these words, I don't know what they mean. This lets a lot less water than is usually used to do a lot more work. No soil means precise control over what level of nutrients are at the roots. It also eliminates weeds and helps keep down microbes, insect, and other crop devouring pests. No soil also means no fertilized runoff into waterways. Vertical farms are you seeing any intangibles there? A lot of intangibles, that project. The question on this one is, can you get the data? But obviously the data exists because people are doing it. So the question is, can you find it? My guess is you'd be able to find a lot of good data on that. So yeah, go move to New York. When you get your job at Alliance Bernstein in New York City, and you open up a vertical farm in your condo, and that'd be interesting. Space travel. I had one team last semester, they were going to do space travel, and I said, I don't think you can get the data. And they said, oh, we can. And then 3 weeks later, we're not going to do space travel. So yeah, I kind of thought that it's kind of tough to do. So those are some ideas. It doesn't have to be one of these, but you see that you have some investment up front, benefits in the future that you can forecast, and tangibles you can talk about, sensitivity analysis that you can do, and then make sure it's something you really don't know the answer to. If you can find all of those things. So what I want to do is take, oh man, we're kind of, I tell you what, we'll take the next, yeah, we're kind of out of class anyway. So let's take the next 10, 15 minutes, your teams just talk about it, all right?